Two people, same city, same industry, same $150,000 in gross revenue this year. One of them will write a check to the IRS for $41,000, get sued by a client in February, and spend 3 weeks of their life untangling a contract dispute that touches their personal savings account. The other will pay $27,000 in taxes, hold their assets behind 2 layers of legal separation, and borrow against their business structure at a rate their bank reserves for established commercial borrowers. The difference between them is not income. It is architecture. This is where that architecture starts. At zero, level 0. You are a freelancer, a contractor, a consultant who sends invoices from a Gmail address and receives payment into a Chase checking account with your name on it. Everything you earn is self-employment income. The IRS sees it, taxes it at ordinary income rates plus the full 15.3% self-employment tax on the first $160,000 and sends you a bill. There is no separation between you and your revenue. If a client claims your work caused them a loss and files suit, they are filing against you, not a company. You, your savings account, your car, your brokerage, whatever you have built, it sits in the same legal container as the risk. This is the starting point. It is not shameful. It is just exposed. And exposure is what the structure is designed to remove. Level 1, $10,000 to $100,000 in annual revenue. This is the single member LLC. You form it in your state for between $50 and $500 depending on where you live. The name goes on the registration. A separate bank account opens under that name the same week, not a personal account with a business label on it. A separate account. The LLC has its own debit card. It receives client payments. It pays business expenses. You draw a distribution. That single act of separation, the bank account, is what makes the entity real in a practical and legal sense. Contracts move into the LLC name. Your engagement letters, your service agreements, your vendor relationships. Simple bookkeeping starts here. Revenue in, expenses out, a monthly reconciliation that takes 40 minutes. The protection is not absolute. Courts can pierce the veil of a single member LLC if you treat it carelessly. The carelessness they look for is commingling, personal expenses run through the business account, business expenses paid from your personal card, no records of what belongs where. You prevent that by maintaining the separation without exception. This is not complex, it is just consistent. Level 2, $100,000 to $500,000 in annual revenue. This is where the first real holding structure appears. You form a second entity above the operating company. Blue Oak Holdco LLC sits at the top. It owns 100% of Blue Oak Marketing OpCo LLC. The operating company is where the client work happens, where the contracts live, where the employees or contractors are engaged, where the legal exposure concentrates. Holdco owns that company but does not touch clients. It does not sign service agreements. It does not appear on invoices. What it does is receive money. OpCo pays a management fee upward to Holdco for strategic oversight, administrative services, whatever the actual intercompany relationship supports. Profit distributions flow from OpCo to Holdco as a sole member. The accumulation happens at the Holdco level, separated from the operational risk sitting one layer below. If a client dispute escalates into litigation against the operating company, the assets held in Holdco are not in the same room. Asset separation follows the same logic. You create a third entity. Blue Oak IP LLC holds the brand assets, the proprietary processes, the templates, the software licenses, the domain names. It licenses these to OpCo under a written agreement at a documented monthly rate. OpCo pays the licensing fee. That payment is an expense at the operating level and revenue at the IP level. A fourth entity, or a standalone arrangement within Holdco, holds any equipment, vehicles, or physical assets. Those are leased back to OpCo. You keep the things that have value away from the thing that carries risk. The operating business can be risky because it is supposed to be. That is where the work happens. The assets are clean because that is where the value accumulates. The tax mechanics at this tier are straightforward but meaningful. All of these entities are pass-through structures by default. Income flows to the owner's personal return. No entity level tax. But the characterization of that income matters. A distribution is not self-employment income. It is not subject to the 15.3% self-employment tax. Only what the IRS considers reasonable compensation triggers payroll taxes. This is why the S corporation election becomes relevant, somewhere between $80,000 and $150,000 in net profit. You elect S corp status on the OpCo or on a payroll entity, pay yourself a documented reasonable salary, run payroll through it, and take the remainder as a distribution. The people who think of income as a single category pay the full freight on every dollar. The people who understand characterization do not. The sample stack at this level looks like this. Blue Oak, Holdco LLC receives distributions from both Blue Oak Marketing OpCo LLC and Blue Oak IP LLC. OpCo generates $400,000 in gross revenue, carries $210,000 in expenses and salaries, and nets $190,000. A management fee of $18,000 flows to Holdco. Licensing fees of $24,000 flow to IPLLC and then up again. Holdco accumulates capital. That capital, sitting in a clean entity with no operating liability, is the beginning of the machine. At $1 million in equity, the architecture stops being theoretical. The entities exist, the accounts are separate, the intercompany agreements are signed, but the governance is still informal, and informal governance at this scale is a liability waiting to locate you. This is where you formalize everything. The operating agreements get rewritten, not the template you downloaded in year one, but a documented governance structure with capital accounts, membership units, distribution waterfalls, and decision thresholds. Who can sign a contract above $50,000? Who can authorize a line of credit? What requires member consent versus manager discretion? Holdco receives a proper cap table, even if you are the only member. Especially if you are the only member, because the document you write now is the document a bank, a partner, or a buyer will read later. The intercompany agreements move from informal understandings to executed contracts. The management fee from OpCo to Holdco is documented at a specific monthly rate tied to services rendered. The IP licensing agreement specifies the assets covered, the royalty structure, and the renewal terms. The equipment lease between the asset holding entity and OpCo has a stated term and a market rate payment. These agreements exist because the IRS can recharacterize transactions that lack economic substance. Economic substance means there is a real agreement with real terms enforced consistently. Between $1 million and $5 million in Holdco equity, the company transforms from an income vehicle into an accumulator. The objective changes. OpCo continues generating cash. That cash does not stay in OpCo. OpCo stays lean, carries minimal retained earnings, and remains insurable at favorable rates. Excess profit moves upward through distributions and management fees to Holdco, where it buys assets. A real estate LLC gets formed. Holdco funds the acquisition of a commercial property. The property is leased back to OpCo at market rate. OpCo pays rent, which is a deductible expense. Holdco, or the real estate entity, receives rental income, which carries depreciation offsets that the operating business cannot generate on its own. The building appreciates. The mortgage amortizes using OpCo's cash flow. The equity compounds in a structure separated from operational liability by one or more entity walls. The tax mechanics at this tier are not aggressive. They are structural. Reasonable compensation gets set once per year based on documented analysis of what the role would pay in the open market. That number runs through payroll. Everything above it moves as a distribution, not subject to self-employment tax. The management fee strategy works because Holdco provides real services, strategic planning, treasury management, compliance oversight, and the fee reflects that. Entity elections matter here. Some operators move a second OpCo into C Corp status to retain earnings at the 21% flat rate rather than passing them through to a personal return at 37%. Others keep everything as pass-throughs and deploy capital before year-end into bonus depreciation assets. State tax considerations become real when you operate across state lines. Nexus in a second state creates filing obligations in that state. The structure has to account for where income is sourced, where employees are located, and where the contracts are performed. Debt and leverage work differently here than in the early years. A bank underwriting a loan against OpCo is underwriting cash flow. 2 to 3 years of tax returns, a profit and loss statement, debt service coverage ratio above 1.25. That is the analysis. Holdco collateral, the building, the equipment, the ownership interest in the operating companies creates a second underwriting track. The bank sees both. Personal guarantees are still present at this level, usually required, but the terms begin to shift. As Holdco equity builds and OpCo demonstrates consistent cash flow, the guarantee becomes less onerous relative to the asset coverage underneath it. Operators who maintain clean books, audited or reviewed financial statements, and a disciplined intercompany payment history shrink their personal exposure faster than operators who keep everything informal and renegotiate every year. Between $5 million and $20 million, the structure expands horizontally. A second operating company gets formed, then a third. An operator who started in HVAC acquires a plumbing company. Then an electrical contractor. Holdco owns all three. A fourth entity, the Services Co., gets formed to centralize functions that all three opcos need, but none of them should duplicate. Accounting, human resources, fleet management, insurance procurement, marketing. Services Co. employs the back office staff. It bills each opco a documented service fee based on actual resource allocation. Each opco stays operationally clean. Its financials reflect the business it is actually in. The shared cost structure improves margins across all three. The bank sees three operating companies with contained expense bases and a centralized support structure. The underwriting is cleaner than if each opco carried its own overhead. Liability containment at this scale is not conceptual. It is jurisdictional and contractual. Each opco is siloed by line of business and, where applicable, by geography. A lawsuit arising from the HVAC work cannot reach the plumbing company's assets because they are not in the same entity. They are not even in the same operating agreement. Holdco holds ownership interest in all of them, but it does not operate any of them. The wall between Holdco and opco holds as long as you do not cross-collateralize. Cross-collateralization happens when a lender secures a loan against multiple entities simultaneously, or when intercompany loans are structured sloppily enough that a creditor can argue that Holdco is liable for opco's obligations. That wall, once breached, does not quietly repair itself. Here is what the structure looks like with numbers. Patriot Holdco LLC holds 100% of Patriot HVAC OpCo LLC, 100% of Patriot Plumbing OpCo LLC, and 100% of Patriot Real Estate LLC. The two operating companies together generate $8 million in combined annual revenue. After expenses, payroll, and management fees to Holdco, they net approximately $1.1 million. The Real Estate LLC holds a commercial property carried at $2.5 million, mortgage balance of $900,000, net equity of $1.6 million. That property is leased to the opcos at market rate. Holdco equity across all positions sits at $3 million. That $3 million did not come from a single event. It came from years of disciplined upward capital movement, management fees paid monthly, distributions cleared quarterly, assets acquired systematically, and nothing left in the operating layer that did not need to be there. At $50 million in consolidated value, the structure stops being a small business with good entity hygiene. It becomes an institution, and institutions operate under different rules than owner-operators. Not different laws, exactly. Different expectations. Banks expect audited financials, not reviewed, not compiled, audited. Institutional partners expect consolidated reporting across every subsidiary on a single set of statements that eliminates intercompany transactions and presents the group as a unified economic entity. PE firms, family offices, co-investors, and senior lenders all expect a clean entity chart they can read in 30 seconds. If your chart requires a 20-minute explanation, you do not have a structure problem. You have a credibility problem. The explanation is the problem. This is where professionalization happens at the governance layer. A board gets formed, not advisory in name only, but a functioning board with documented authority, scheduled meetings, written consents, and minutes kept consistently. Outside advisors with actual domain expertise get appointed. A CFO or fractional CFO steps in to own the consolidated reporting function. The entity chart gets redrawn by a transactional attorney and a tax structuring team working together, because at this tier the two disciplines cannot operate independently. What the lawyers design, the tax team either endorses or vetoes. Both disciplines sit at the same table before the documents are signed. The model at this tier is the platform. Topco, sometimes called Holdco at the top of the stack, owns multiple opcos. Each opco is a distinct operating business, separate financials, separate bank accounts, separate management, separate liability exposure. Topco does not operate, it owns. A finance co or treasury function gets created either as a separate entity or as a defined function within Topco to control the flow of cash across the group. Intercompany loans get documented with market rate interest, defined repayment schedules, and subordination agreements where senior lenders require them. Cash sweeps from the opcos into the treasury function on a defined schedule. Capital gets redeployed from the center rather than left sitting in individual operating accounts where it earns nothing and creates unnecessary exposure. Acquisitions at this level have a specific mechanical structure. When Topco acquires a business, it does not acquire it directly. A newly formed acquisition subsidiary, sometimes called Acquico or Newco, gets formed specifically for that transaction. Acquico buys a target. If the deal goes wrong, if there's undisclosed liability, if a lawsuit surfaces post-closing, it surfaces inside Aquico, not inside Topco, not inside the other opcos. The wall contains the damage. Consider a specific example. Topco is acquiring a regional logistics company generating $14 million in annual revenue. Purchase price is $31 million, a 2.2 times revenue, multiple with a slight EBITDA premium. The deal is structured with $22 million in cash at close, $5 million in seller rollover equity issued as units in Topco itself, and $4 million in a 2-year earnout tied to EBITDA targets. The seller does not receive only cash. The seller becomes a minority unit holder in Topco, aligned with the broader platform's performance. The earnout sits in escrow. The rollover equity sits on Topco's cap table. Aquico merges into the existing logistics OpCo 60 days, post-close once integration is complete. The acquisition subsidiary has done its job. It contained the transaction risk. It no longer needs to exist as a separate entity. Tax architecture at this tier becomes jurisdictional. Subsidiaries get organized in the states where they operate, and those elections are deliberate. Where pass-through treatment serves the group, it stays. Where retaining earnings at the 21% C Corp rate is advantageous, a C Corp blocker gets interposed between Topco and a specific OpCo. Dividends, interest, and royalties move inside the group along paths that are documented and defensible. An IP holdco entity holds the group's intellectual property, its software, its brand, its proprietary systems, and licenses that IP to the OpCos at a documented royalty rate. The royalty is a deductible expense at the OpCo level. The income accumulates inside IP holdco in a cleaner, more protected structure. Real estate sits in dedicated propcos, one per property or one per geographic cluster, separated entirely from the operating businesses. Those propcos generate rental income, carry depreciation, and are never cross-collateralized with the opcos they serve. Asset protection at this scale is both structural and contractual. The entity walls do the first layer of work. Insurance does the second. An umbrella policy covering the group, plus individual coverage at each opco, plus directors and officers coverage at the board level. The third layer is contractual indemnities built into every intercompany agreement, every management services contract, and every lease between a propco and an opco. These three layers do not replace each other. They stack. The capital stack at the platform level introduces complexity that the owner-operator tier never encountered. Senior debt sits at the top, secured by the opcos' assets and cash flows, priced at the tightest spread, carrying the most restrictive covenants. Mezzanine debt sits below it, unsecured or lightly secured, priced higher, carrying PIK provisions or equity kickers. Minority equity investors, sometimes family offices, sometimes co-investors from a prior deal, sit below the mezz. Topco equity, owned by the founder or the founding group, sits at the bottom of the stack and captures the leveraged upside. Leverage magnifies equity returns when the underlying businesses perform. It also magnifies the need for ring fencing, because a covenant breach in one opco can trigger cross-default provisions in the senior facility if the documents are not drafted carefully. The attorneys who negotiate those covenants are not interchangeable with general counsel. This is specialist work. Here's what the org chart looks like with numbers. Topco is valued at $200 million. It owns 6 opcos generating $120 million in combined annual revenue. It owns IP Holdco, which holds all group intellectual property and licenses it back to the 6 opcos. It owns 3 propcos holding $60 million in real estate, mortgage at $35 million, net equity of $25 million. It owns a services co that employs the shared back office staff, charges each opco a documented cost plus fee, and keeps the individual opco financials clean of overhead that belongs at the center. Topco's consolidated financials eliminate every intercompany transaction and present a single coherent picture. That picture is what an institutional buyer, a lender, or a strategic partner reads. The entity chart is not bureaucracy. It is the instrument through which every dollar of value is held, protected, moved, and ultimately realized. At $1 billion in consolidated enterprise value, the structure stops being about protecting the business from external risk. It becomes about protecting the business from time, from the founder's mortality, from family disagreement, from generational drift, from the slow erosion that happens when wealth transfers without architecture to hold it in place. The entity chart at this level has 4 distinct layers. At the top sits Family Holdco, sometimes called Parent Co, a holding entity owned by the founding family through trust, not directly. Below it sits the operating group, the platform of opcos built during the 50 to 300 million phase, now mature, generating consistent cash. Below that sit the asset holding entities, the propcos, the IP holdco, the securities portfolios, the alternative investments. And alongside all of it sits the family office function, which is either a standalone entity or a defined division inside family holdco, managing investments, coordinating compliance, filing consolidated tax returns, and running the treasury function that the platform tier introduced. Each layer has a defined role. None of them overlap by accident. Control and economics get separated at this tier in a deliberate and documented way. The mechanism is dual class equity. Family Holdco issues two classes of units. Class A units carry 1 vote per unit. Class B units carry 10 votes per unit, or 20, or whatever multiple the attorneys and the family agree reflects the appropriate control premium. The founder holds Class B. Adult children receiving gifts receive Class A. The economics, meaning the distributions, the liquidation preferences, the percentage ownership of enterprise value, flow proportionally. The control does not. A founder can transfer 60% of the economic value of Family Holdco to the next generation over a decade of structured gifting and still retain voting control with 15% of the units. This is not a loophole. It is how institutional capital has always separated governance from economics. The same structure that governs publicly traded, founder-led companies governs private family enterprises at this tier. Preferred equity layers in below the common in certain structures, particularly where outside investors or estate planning vehicles hold a specific return preference. The preferred is patient. The common captures the upside. The voting structure determines who decides. Succession planning at the dynasty level runs through 3 instruments operating simultaneously. The first is the revocable living trust, which holds the founder's direct interest in Family Holdco and every other asset titled in the founder's name. It is revocable because the founder can change it. It becomes irrevocable at death. Its function is not tax minimization. Its function is probate avoidance and continuity. When the founder dies, assets inside the revocable trust transfer to beneficiaries without court intervention, without public record, and without the delay that makes business continuity impossible. The second instrument is the irrevocable trust, which exists to move assets out of the founder's taxable estate while the founder is alive. Assets transferred into an irrevocable trust are no longer the founder's assets for estate tax purposes. They belong to the trust. The appreciation on those assets accumulates outside the estate. The third instrument is the Family Limited Partnership, or Family LLC, which consolidates the family's collective interest in the operating group and the asset holding entities inside a single vehicle that the founder controls as general partner or managing member. Minority interests in that vehicle get gifted to the next generation at valuations that reflect lack of control and lack of marketability discounts. An interest worth $100 at the entity level may be valued at $65 or $70 for gift tax purposes when it represents a non-controlling, non-marketable minority stake. The difference is not fiction. It is recognized valuation methodology. Estate minimization at scale uses the same principles applied systematically over time. Grantor trust structures allow the founder to pay income tax on trust earnings personally, which is itself a tax-free gift to the trust beneficiaries, because the assets inside compound without being reduced by the tax liability. Annual gifting uses the exclusion available to each donor for each recipient. Structured instruments move larger blocks of value across generations with defined term and interest rate assumptions built in at the time of transfer. The asset that matters most is not the one with the highest current value. It is the one with the highest expected future appreciation, because the goal is to transfer appreciation out of the taxable estate before it occurs. What is already inside the estate is expensive to move. What has not yet compounded is cheaper. Governance at the dynasty level is what separates inherited wealth from dissipated wealth. The family constitution is a governing document that is not a legal contract. It is a written statement of the family's values, its investment philosophy, its distribution policy, its rules for employment in the operating businesses, and its process for resolving disputes. The document gets drafted with input from all family members old enough to participate and gets revisited on a defined schedule. Alongside it, Family Holdco's operating agreement or shareholder agreement specifies independent directors, not advisory board members. Directors with defined authority, fiduciary duties, and the ability to block distributions or capital decisions that exceed documented thresholds. The independent directors exist to protect the institution from the family, not from outside parties. The entity is designed to outlast any individual decision maker, including the founder. Multi-generational asset protection separates legacy assets from operating risk with the same firewall logic used at the platform tier, applied now across time horizons measured in decades. Real estate, intellectual property, and marketable securities sit inside, holding entities that are never cross-collateralized with the opcos. A creditor of an operating business cannot reach the family's real estate portfolio. A judgment against a family member in the second generation cannot reach the operating group. The walls are not impenetrable. They are deliberate. They require consistent maintenance, documented intercompany agreements, separate governance, and no commingling. The maintenance is the architecture. Here is what the full progression built. At 0, a single person and a bank account. At the first real entity stack, an LLC and a holding company separating personal from business. At the owner-operator group, an opco, a holdco, and a propco moving income into protected positions. At the platform, topco, 6 opcos, IP holdco, services co, and a treasury function generating institutional grade reporting. At the Dynasty, family holdco, operating group, asset holding entities, and a family office function designed to survive the founder entirely. Pull up your own entity chart, not the one in your head. The actual documents, count the layers, identify what each entity holds, what it owes, and who controls it. That chart is either a system or it is a collection of paperwork. The difference is intentionality. Build the system.